Same stock, same gain. One executive paid $166,000 in tax, another paid zero. A decision most executives don't know they're allowed to make. If one company makes up more than one half your net worth, RSUs you let ride, founder shares, options you exercised and never sold, you already know the feeling. On paper, you're wealthy. In reality, you're trapped. Because the moment you try to sell and actually diversify, you hand the IRS a check. On a $1 million position with a $700,000 embedded gain, that check is $166,000, so you don't sell. You tell yourself you'll do it next year, and every year you wait, your entire financial life stays bet on a single stock price you don't control. Here's the part nobody tells executives at your level. That $160,000 number is not fixed, it's a dial, and you get to choose the setting. I'm going to show you 3 settings on that dial, using the exact same position. One pays $166,600, one pays about $43,000, and one pays zero, while you stay fully invested and diversified. But one of the ways to reach zero is actually a trap dressed up as a tax win. Pick it for the wrong reason, and you'll lose far more than you save. I'll show you which one and how to tell if it's you at the end. If you have equity comp and nobody has ever modeled what selling actually costs you or shown you how to make the cost a choice instead of a penalty, subscribe. This channel is built for exactly that decision. I'm Klemm, founder of Inflection Point. We help executives coordinate equity compensation with the rest of their financial life, and this coordination is the part most advisors skip. Quick honest note, this is education, not investment advice, not a stock recommendation, and every number you'll see is illustrative. Stay to the end and you'll walk away with 3 things: the 3 dial settings, the real risk hiding behind the zero tax version, and the one question that tells you which setting fits your situation, not someone else's. There's a name for what you're living in. I call it the concentration trap. It has 2 jaws. The first jaw is the risk of staying. One company, one earnings miss, one regulatory headline, and a decade of compensation reprices overnight. The second jaw is the tax of leaving. The $166,000 you owe the day you finally diversify. Most executives feel both jaws and freeze, so they default to the most expensive option on the board without ever realizing it was an option. And if your equity is more than half your liquid net worth right now, you're standing inside that trap, whether or not anyone's named it for you. The good news, the second jaw, the tax, is the one you can actually control. Let me show you all 3 ways, starting with the one you're probably on. Setting 1 is the default. You sell the whole position in a single year. $700,000 of gain taxed at the long-term capital gains rate plus the net investment income tax, 23.8%. That's $166,600 gone in one tax year. Nobody chose this on purpose. They back into it because selling all at once is the only move anyone ever explained to them. But writing that check is only the default. It is not the only setting. Here's where it gets more interesting and more expensive not to know about. The second setting has a name too, the equity translation, converting concentrated stock into a diversified portfolio without detonating the tax bomb on the way out. Here's the mechanism, and it's the part that's invisible to most people. A tax-aware long-short equity strategy does 2 real jobs at once. It puts your capital to work in an actively managed, diversified portfolio that's aiming to beat a benchmark. That's the economic reason you do it at all. And as the byproduct of normal trading, it realizes net capital losses along the way. Those losses are real, and the tax code lets you use them to offset gains, including the gain on concentrated position you're finally selling. Here's the rule of thumb that makes it concrete, and it runs in cents on the dollar. The more active risk the strategy takes, the more losses it tends to realize in the early years. At a moderate setting, one published research study found the strategy points to a little over 50 cents of every first year realized losses for every dollar you commit. The results of the study show that if you dial the actively risk higher, that can climb to 70 cents on the dollar or more. Please note that this study was hypothetical, back-tested, net of fees, but that's the range you may be working with. Let me show you what that does in practice. Take an executive, call her Lisa, director at a public company, a $1 million position in her employer's stock, $700,000 of embedded gains. She commits $1 million of other taxable capital, cash or an existing brokerage account, into a tax-aware long-short strategy. At the moderate setting, a little over 50 cents on the dollar, her $1 million realizes roughly $520,000 in first-year losses. Those losses offset $520,000 of her $700,000 gain. The leftover $180,000 gets taxed at the 23.8%, so her tax bill drops from $166,000 all the way down to about $43,000. roughly 3/4 of the tax gone from structure alone. Now dial the risk up. At 70 cents on the dollar or higher, that same $1 million realizes north of $700,000 in losses, enough to absorb the entire gain. She sells, she diversifies out of the single stock, and the tax on that sale alone is zero. Still fully invested, still in the market, just no longer betting her whole net worth on one ticker. And if your equity situation looks like Lisa's, a big single stock position and other capital you could deploy, this is the dial you're sitting on right now. Whether or not anyone's shown it to you, you pick the setting. But, and this is the honest part about Noe puts on the thumbnail, the dial isn't free. The setting that generates more losses also takes more active risk. More loss generation means higher tracking error. The portfolio can deviate further from the market, up or down. There's a real management fee, and the loss figures are projections, not promises. They vary year to year, and they're the largest in the early years, which is exactly why a big first-year harvest can swallow a one-time gain like this. You're not making tax disappear by magic. You're realizing real investment losses and a real strategy with real risk and using them the way the tax code explicitly allows. The reason to do it is the diversification and the return potential. The tax result is the consequence, not the trick. If you've got a concentrated position with large capital gains and you're wondering which one of these strategies can help you mitigate your taxes, there's a link below to schedule a consultation. I'll be honest with you, almost every executive who comes into my practice comes in confused about exactly this. They've got an advisor, sometimes a generally good one, who knows retirement planning and knows investing, but they don't know how to coordinate a concentrated stock position with a tax-aware strategy with an estate plan. So each piece gets handled in isolation. Nobody's holding the whole picture, and the year-end tax bill reflects exactly what you'd expect when no one is. That's what frustrates me about how this industry sometimes handles executives. You don't need someone to sell you a product. You need someone who can actually see the dial and tell you, for your facts, where it should be set. Setting 3 is the genuine zero, and there are 2 clean paths to it. Both require a specific fact to be true about you. Path A, the donor advised fund. If you already give to charity, you donate the appreciated shares directly instead of cash. You take a deduction at the full market value, and the capital gain is never realized. Zero tax permanently. If charitable intent already exists and certain tax considerations hold true for you, don't manufacture giving to dodge tax. That math never works. Path B, the step up at death. You hold the position for the rest of your life. Under current tax law, at death, your heirs receive a stepped-up basis. The embedded gain resets to zero, and the deferred tax simply evaporates. Now, here's the trap I promised you at the start. On paper, Path B looks like the best outcome on the board. Pay nothing ever. But look at what it actually requires. You have to hold the concentrated position until you die, which means you never diversify. You stay clamped to the first jaw of the concentration trap. One company, your entire net worth, for the rest of your life, just to avoid a tax you could have managed down to near zero anyway while getting out. That's the trap. The $0 by never selling outcome is the concentration trap winning, wearing a tax savings costume. It's the right answer only if you genuinely never need the money and the legacy is the point. For almost everyone else, a near zero bill on a position you've actually diversified beats a zero bill on a position that can still cut your wealth in half overnight. So why is almost everyone still on setting 1? Not because they ran the numbers and they chose it, because no one laid the dial in front of them. No coordinated strategy, cash gifts instead of stock, no estate plan tied to the equity. The $166,000 isn't a decision, it's the cost of indifference, paid by the people who could afford the advice and never got the coordination kind. Let's wrap this up. Same position, same gain, 3 settings. $166,000, $43,000, or 0. And one of those zeros is a trap. The difference was never the stock, it was whether anyone showed you the dial. The mechanism in one sentence: diversify the concentration into an active strategy whose losses as a byproduct offset the gain, and layer giving or estate planning only where the facts genuinely fit. You're sophisticated enough to run hundreds of millions in your day job. You shouldn't have to back into the most expensive tax outcome in your personal life because nobody coordinated it. So here's the one question that tells you your setting. Do you need the capital working for you in your lifetime, or is it legacy you'll never touch? If you need it, you're a dial and diversify case. If it's your pure legacy with charitable intent, you have a true zero path. Most of you are at the first one and have been told to act like the second. If you want that modeled on your actual numbers, your position, your gain, your other capital, where the dial should sit, That conversation belongs on my calendar. Link in the description. No pressure, no pitch, just your specific numbers. And if you know another executive sitting at a concentrate position they're afraid to touch, send them this. It's the most expensive video they'll ever watch and the cheapest. I'm Aaron Klemm. See you in the next one.